Monday is Memorial Day, a day we will honor all those who died in defense of our country, in defense of us. Typically, these deaths occurred on foreign soil. Can you imagine for an instance how terrifying, lonely, and depressing it must have been? I imagine these soldiers as old and wise, resembling the founding fathers, aged and gray-haired, but the truth of the matter is most of those who died were young men. Remember on Monday how they gave up two lives, the one they were living right then and there, and the one they would have lived at home as a husband, father, or grandfather. They gave up everything for our country, for us, for freedom, your freedom, and all we can do is remember. So this weekend or Monday, if you get an opportunity, watch the opening scene to Saving Private Ryan to get some inkling as to what they went through. And just think about someone you know who serves right now, whether it's in the military, our police force, our fire folks, all brave men and women out there who take care of us every day. Freedom is not free. The costliest peace is far cheaper than the cheapest war. Hey, good morning. Welcome to Protect Your Assets. I'm David Hollander. We have a lot to talk about today. How are you doing? Long weekend. If you're feeling concerned, maybe a little unsettled about your accounts, balance just keep going up. They look so great. The market's wonderful, right? But what's shifted? What's changed? Why are we way up? And what's going to happen next? That's the big question. With interest rates right now jumping around, being uncertain, what's the Fed going to do? You see, it's not about return once you retire. It's about income. Income that maintains your lifestyle, no matter what's going on in the markets. If your returns tomorrow could change, or if your stocks could lose substantial value, then what are you going to live off of? Are you able to recover this late in the game? The good news for you today is I'm going to share with you 3 ideas you can do right now to play defense with your investments. If this year has rattled you at all, then you can't afford to miss the show today, so stick around. Now, let's get started. So the S&P just logged its 8th straight winning week. This is the longest streak we've seen since 2023, and the Dow hit a new intraday record high this past week. So how much longer can the rally go on, and what's going to happen to rates? Because this past week we saw them go up when I thought they were going down. So the Dow Jones Industrial Average closed the week at 50,579. So we're well over the 50,000 mark. It was up 2.1% for the week. Year to date up 5.2%. S&P 7473. Unbelievable, right? Up almost 1% for the week. Year to date up 9.2%. NASDAQ up about 0.5%. Year to date up over 13%. And the Treasury, that's the big story right now. The 10-year Treasury and interest rates 4.58%. Remember, we were talking about that 4.5% threshold. So we've crossed it. We've closed above it. It's at 4.58 right now. And that's the big question. What's going to happen to rates? Crude oil, $97 a barrel. Rolling around there on the streets, you see the price at the pump and on the tank. I know, shaking your head. Year to date up 35%. Whew. And the MSCI International Index finally in the positive, up 3.3% year to date. The rise in yields, that's what I was just talking about with 10 years. It's approaching levels that could begin to weigh on the stock market, especially after a strong 2-month run we've just seen in stocks. Why? Higher rates pressure valuations on companies. It just becomes more expensive to borrow money. And as those rates creep into the 5-6% area, bonds become competitive to stocks and could test the rally. We're seeing very strong investment demand. We're seeing improving productivity. Earnings remain the key support right now for equities, with first quarter profits rising at the fastest pace since 2021. So where's the blemish, if you will? It is in the narrow leadership that we're seeing right now, which is bringing everything up. Fixed income world, the rise in yields. This is a double-edged sword. How? Higher yields, well, they pressured the near-term rates right now higher. You see U.S. investment grade bonds are going lower for the year overall, but they also have some opportunities out there. What can you do about it right now? Well, you definitely should speak to your financial advisor at the Liberty Group who can help you navigate this economic, geopolitical landscape right now that we're dealing with, and make sure that your portfolio and your investment plan, well, that it's on track to achieve the goals that you've set out there. Make sure that you have income from your portfolio, even if the market does what it could do. And so if you need any help with this, you know the number, 866-PROTECT. That is the number to call. More than happy to help you out. Now, when I come back with this market at all-time highs, what can you do now to protect your retirement so the income will be there when you need it? Find out. You're listening to the Protect Your Assets show. We'll be right back. Welcome back. I'm David Hollander, also known as the Sandman, and you are listening this morning to Protect Your Assets. And right now, the stock market is at all-time highs. We just keep setting new records each week. And add to that, rates just started rising once again. Good morning, and welcome to the long weekend. It is Memorial Day. If you missed my market segment, I was talking about what we're seeing right now, what we're thinking is going to happen, then go listen to our market podcast. Wherever you get your podcast, you can just type in Protect Your Assets and then the market segment. Look for the most recent date, and that'll give you the update on what's going on in the market and why we maybe did some trades in your account. Many people right now, they're becoming more and more concerned about the war with Iran. How could a protracted military engagement with a country like Iran escalate into something much worse? It's a very good question. And if it did, what would that do to your retirement, to the market? We've had a lot of volatility this year, that's for sure. Thinking back to April, what that looked like, and now where we are today, it is what it is. And so if you're tuning in right now, we're talking about how would you play defense with your portfolio in this volatile environment, particularly if you're going to retire in a few months. Maybe this is your last year, and you're looking to start to build that nest egg. So when you retire, it's there to start drawing down on to supplement your retirement income. After all, you have to do that. It's not like you're going to get a paycheck every 2 weeks once you quit. So that's it. You're on your own. Consider this. Just think about this, because I think this weekend's a great time to think. You got an extra day. And consider this. The average bear market, this is the average now, for the S&P 500 since 1929. You know what it is? It's almost 40%. It's 39.9%. That's the average. And as you consider what just happened in April and where we are now, if you look at that swing, it's over 20%. That's the kind of volatility we're looking at right now. So I'm just saying, it's impossible, of course, to predict where the market's going to go next week or the week after that. But one thing is certain. You're going to need that paycheck every 2 weeks or every month at least to pay your bills when you're retired. It's just that simple. And of course, the taxes don't stop. You got to file your return and pay your taxes. And where are you going to get the money to do that? Then the county taxes on your real estate are due. Where are you going to get the money to do that? So how can you create a dependable cash flow off your portfolio if you're getting ready to retire or you're retired right now, given the fact that this market has become more volatile? It's an excellent question. And if you consider the last few years of ultra low rates and then rising rates for a brief period of time, then rates going down a little bit recently, and then now going back up this past week. A lot of you have flooded into cash and money markets and short-term CDs because those yields, particularly a year ago, were pretty attractive. But as rates start to come down, which they did, and if your bonds or money markets, which are in cash, start to renew, then that creates a problem for you because you've become comfortable earning 4 and 5% in cash. And that type of return, particularly now, it's unlikely to persist. And so waiting longer is not a neutral decision anymore. U.S. money market balances have grown from roughly $4.8 trillion 5 years ago to get this right now, they're $8.2 trillion. Can you believe that? Every dollar sitting in those accounts is facing potentially declining future yield, declining future cash flow, and potentially more taxes. You're going to pay taxes on any taxable money market for sure, but could those taxes be higher later as well? So now you're talking about a double whammy. So if your objective right now is to lock in the rates that are there right now, this past week we saw some really nice rates all of a sudden. Then right now we've got some things that are interesting. Think about this. On a 3-year, this is called a MIGA. I don't know if you ever heard of a MIGA. If you haven't, give us a call. We're happy to share that with you. On a 3-year right now, we're getting 5.65%. It is May 23rd. These rates do change. On a 5-year, over 6%. MIGA. What else could you do? Well, the other thing you have to think about is what's called sequence of return risk. Now, that in itself is a radio show, and I've done a show on that, so you can go again to the podcast, type in Protect Your Assets, SOR, or Sequence of Return Risk, to find out what that's all about. It's not something you want to ignore, particularly if you're getting ready to retire. And right now, there is a way to take advantage of that. What do I mean by that? Well, there is something called an FIA. Again, I did a show on these too. It's called fixed indexed annuities. There are millions of types, maybe not millions, but thousands of types of annuities out there. Okay, lots of them. And they're not all bad. There's some good ones. In fact, right now, there's one that's paying a 10.25% cap on the S&P 500. I'm going to get into that a little bit later, but that's what it is right now. It's a pretty good rate. And these FIAs, some of them have income riders. And what those basically do, if you have a pension or you know someone who has a pension, is create a pension for yourself. Because that's what your companies do. When you have a chunk of money in a pension account, what do you think they do with it? Well, when you tell them you're getting ready to retire, you usually got to give them some notice. Typically, it's 30 days. Then they look at that balance, they go out and they shop, and they come back to you and they say, well, if you want a payment that's guaranteed just for your life, of course, they show out there, it's backed by the claims paying ability of that company, insurance company. That's right. It is what it is. Okay. So if your company's picking that and they're going to say, okay, just on your life, it's going to pay you this amount. And then if you want to add your spouse to that and you want her or him to get 75% of your benefit or 50% of your benefit or 25% of your benefit, then you would get this benefit. So you're usually looking at 4 or 5 different numbers, and you have to decide which one you want to do. And of course, you take into consideration your health, your spouse's health, your longevity, as much information as you can do at that moment in time. Well, I would recommend that you compare what they show you if you have that option. And if you don't have that option, then you create your own pension. So it's time to shop now. Because if you take those funds out of the S&P 500 or any of the stocks that are way up right now, particularly if you have a highly concentrated position in one stock from your company, in a retirement account, because remember, if you sell things in retirement accounts, you don't owe taxes on them until you pull the money out of the retirement account. So you can go ahead and take some of those profits now, lock in those gains, and go shopping. and start to build your nest egg. So when you retire, sequence of return risk doesn't matter to you. And again, I'm not going to define what that is right now. Go listen to the show that I did on that subject and you can learn more about it. Call us, 866-PROTECT. 866-PROTECT. Tell them you want to know more about that. All right. What else can you do? You can maintain your market participation without that downside risk. Here's what a lot of clients are thinking about right now. Like I said, maybe they're in the S&P 500 and they've made 50, 60, 70, 80, 100% returns over the last few years by just sitting in that. Not bad. It's great. Right now, we just hit an all-time high. In the next segment, we're going to talk more about that. And then you can use that to maintain your market participation. I have a new strategy along those lines we'll talk about. But that's a great way to do it. You want to think about creating a predictable income floor. Predictable income floor. Think about that. All right, what's the second thing you can do? Because the first would be looking at the strategies I just talked about, which would be understand how you build income. The next thing you could do right now is focus on risk. And so right now I'm going to offer our portfolio MRI. We have a tool that will stress test your portfolio against simulations like 2008. See what could happen. If you don't know that you could do that or know what that is, then give us a call. We'll be happy to run that for you. 866-PROTECT is the number to get yours. 866-776-8328. Only takes a few minutes and we do all the heavy lifting. 866-776-8328. Coming up next, it is time for our popular They Say segment, where they say by earning lower returns, you're only hurting yourself. Is that true? Find out how playing defense becomes the best offense in these uncertain times. Keep it right here. You're listening to Protect Your Assets with me, David Hollander, the Sandman. We'll be right back. Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And we just keep scratching our heads, right? This past week, the market hit all-time highs. Interest rates have reversed direction, are now going back up. And we all keep wondering, how can this be, given we're at war right now with Iran, and we're wondering what's the next step going to be? How long will this last? And how long will we keep paying for that at the pump? These are all great questions. And so this morning we're talking about some answers about how you would just protect your own specific portfolio so that you have income during challenging times. If and when they come in the future, what do you do? So if you missed the previous segment, we talked about how you can build an income stream using some different ideas that we're currently using with other clients. Also, how to look at your risk, which is super important right now because a lot of people just don't know what their risk is. Things have just kept going up and up and up. And of course, that feels good and looks great, makes you happy. But at some point, when you retire, if you're at or near retirement, you're going to need to convert that into something that would pay you income off of that value. And if that value is higher, you should get a higher income. If it's lower, you're going to get lower income. So what would you like? And so now's the time to start thinking about that if you haven't done so already. So today we're covering that. Now it's time for one of our fan favorite parts of the show. In fact, I met with someone this week who told me that this was his favorite part of the show. So thanks for that. You know who you are. This is our They Say segment where we debunk common myths, half-truths, and sometimes just bad advice that they say. All right, so here's one they say. They say that if the S&P 500 drops 50%, you have to take all that risk. Is that really true? Well, first of all, you got to think about who's saying that and why they're saying that. but I'm not going to point any names, but they're out there. I hear that quite a bit. But I want you to be aware of a way where you can play defense with some of your portfolio right now, while at the same time, if the market goes up, capture some of that upside. Now, you could research some of this. Again, if you type in this word annuities, you're going to see all kinds of things on Google. So try to ignore that and look for the silver lining, okay? First one you should study is a professor named Roger Ibbotson. He says that fixed indexed annuities, these are FIAs, can help you control equity market risk and mitigate longevity risk, meaning how long are you going to live? Do you know that answer? I don't. Maybe you do. But anyway, if you don't, read Professor Ibbotson's article about this subject before you make any decisions. Next, what is an FIA? What's he talking about? He's going to get into a lot of details and tech and numbers and things, and that's great. But coming back to what is it? What is a fixed indexed annuity? It is one of the only products that I'm aware of that's available on the market right now that offers both market-based growth potential while guaranteeing your principal. You're going to see a lot of that word. The guarantee is backed by the claims paying ability of that insurance company, period, end of story. So you have to know what that is and who it is and what it means. Well, there's positives and negatives to everything, of course. This type of fixed index annuities offers you typically a percentage of the gain in the form of some kind of an interest credit if the market goes up, which we've seen a lot of that lately on the S&P 500. In exchange for that guarantee, you don't lose money if that market decides to go down. You could pick an index like the S&P 500 or the Dow Jones or the NASDAQ. And so when you think about this, it's important to understand how it works, of course. And this simple concept is what it is. But historically, here's some of the buts you need to consider. Historically, when the S&P 500 is positive, it exceeds 10% roughly 75% of the time. Think about that. So when you look at a cap-only strategy, even with a nice upside, that upside could be higher than the 10%, according to the statistics here, potentially 75% of the time. Modern indexed annuities make it possible to blend. Here's where you need to think about blending. Blend the strategy that you're doing in ways that still capture more of the market's upside, and you don't abandon that protection you're looking for on the downside. How do you do that? What are some ways to think about this? Well, an allocation strategy that could make sense would be taking a look at taking 25 to 30% of your overall allocation and putting that in what's called an uncapped, volatility-controlled index. It's a very specific word I just used. Maybe you want to write that down. What's an uncapped, volatility-controlled index? Now, all equity volatility-controlled indexes that are offered in these FIAs typically offer what's known as an uncapped participation, meaning if you're in the S&P 500 with this sort of vol control, you get higher participation rates than that 10%, and you capture more of the upside when that index decides to go above and close above the 10% mark for the year. However, the trade-off is they can get knocked around in choppy markets. Like if you think about last year, 2025, it was a very volatile year. And in that year, if you were just in a dynamic intraday TCA index only, you wouldn't have done as well as the S&P 500. But in a market like 2008 or 2022, both of which were pretty historic if you think back on them and the downside that happened, the S&P 500 with the cap and the vol control actually did better than the S&P, which is what you're looking for probably if you're trying to protect some of that growth you've made in the S&P. So this S&P 500 dynamic intraday TC index is part of the component that you could use to blend with this particular allocation strategy if you're thinking about taking some money out of the S&P 500 right now because it's at all-time highs. The intraday index monitors 13 observation windows throughout each trading day. And what it does is it rebalances when a meaningful trend is detected in those 13 windows from the equity to the cash. So if we see low volatility, then it's going to move into equities. If we see higher volatility, then it's going to move your exposure from equities into cash. It's very simple in that regard. The index typically targets what's known as a 15% annualized volatility level. And some of these can provide up to a 250% leverage cap on that S&P. So again, when volatility exceeds 15%, the index shifts allocation towards cash because it is an uncapped in the FIA context, offered with a participation rate rather than a cap. You have the potential to do better if that uptrend continues. So the core thesis about this is pretty straightforward when you just think about it simply. Rather than allocating 100% of, say, that money you just pulled out of the S&P 500 index into just a straight cap 10.25% allocation, which is available right now on the S&P 500 in an FIA that we currently offer, again, backed by that insurance company's claim paying ability, you might want to say instead of 100% into that S&P index, point to point, annual, you decide to take 25 or 30% of that and you drop it into this TCA index. Because again, this year could surprise us. It could continue to go up. Who knows? So here's a way where you can look at getting exposure to the market with some more upside and, most importantly, protect your downside right now, which is probably what you're thinking about. How do I do that in my retirement account when you can't really buy options in your retirement account? That's not something you can do. So give us a call right now to find out how you can learn more about this. We're happy to send you these articles. We're happy to run illustrations for you. You can see what I'm talking about. How do you get this at no cost? Call us, 866-PROTECT. Call this number, 866-776-8328. Tell them you just heard about this protecting your S&P 500. How do you do that? And they'll be happy to take your name and get you some information about that. They're going to need your email too, by the way, okay? 866-PROTECT. It's time for a quick break. But when we come back, find out what else you need to know to protect your assets. It's coming up next. Stick around. Welcome back. I am David Hollander, also known as the Sandman. If you missed the market segment, we were talking about how interest rates have now reversed. This past week, we saw them go the other way. They're going back up again, and we saw the market hit all-time highs once again. This is a scenario that just does not continue typically. So what can you do to protect yourself, protect your retirement, protect your income if things change in the future? You don't want to have to go back to work or change your lifestyle, do you? So today we're talking about the 3 ways to protect your account if you're looking at retiring or you're in retirement. The first one was how to create some income strategies that are agnostic to volatility in the market. The second was to do the risk portfolio MRI. And the third was to look at an allocation strategy that's available right now. This is a new one that we just came across that allows you to capture more of the upside on the S&P 500 while still protecting that downside if that were to occur in, say, an index like the S&P 500. So that's what we were talking about this morning. Go back and listen to the show if you missed any of it. We're talking about protecting your assets right now in this volatile time, in this volatile market. What are some things you should worry about? Well, if you own real estate or you have assets, then you definitely should think about a revocable living trust. This can avoid probate. And so if you have any sort of an asset, find out what your county minimum is. And if you have an asset over that, like a real estate asset, then you probably need a revocable living trust. The next thing you should think about is what's called an asset protection trust. If you're worried about medical bills in the future, if you're worried about a car accident that could happen and you're not insured well enough, or you have a child who's getting married or is married and you don't particularly like their spouse or his or her parents. And so you're wondering how you can protect your assets from those people. Well, you could consider an asset protection trust. These are something that we do. We have an attorney locally who is part of our office who does these. He's been doing them for 62 years, believe it or not. So you can give us a call and we're happy to walk through that and talk about that with you because, again, you need to think about these things before they happen. Now, it is a long weekend. I'd like you to think about all those who serve us selfishly every day. Law enforcement, the fire, and of course, all the veterans and the people out there fighting in the military right now for us, for our freedom, because it is, after all, Memorial Day on Monday. And if you want to just see what that was like back then, watch the opening scene to Saving Private Ryan. It is pretty amazing. And for somebody who's been back to Omaha Beach, I can tell you, it's even more impactful to be there standing on the sand and see and imagine what happened. But hey, watching that show alone will give you some idea of what those guys and women, what they went through, and be grateful for that. I'd like to give a big thanks to the Protect Your Assets team for a great show today. It's been great being back with you. Executive producer, network manager Kevin Renfer. And of course, all my fabulous producers back there, Phil, Raph, Nick, Zach. Because without my team, I'm just another pretty voice on the radio. You've been listening to Protect Your Assets. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.